Hello and welcome to the channel. Please remember that this information is for educational purposes only and does not constitute legal advice, investment advice of any kind. You always have to do your own research, and if you copy trading ideas, you're an absolute moron and you deserve to lose your money. So with that, we're gonna take a look at this stock today, McCormick and Company. So if you don't know much about this organization, they are a global manufacturer, marketeer, and distributor of spices, herbs, extracts, seasonings, and other flavors. So they have in their portfolio very well-known brands like Chilola, like a Mexican sauce. I think they have mustard and other condiments. Now, this organization has reported earnings recently, and they are due to report earnings in late January 2024. So I think it's a good moment to start taking a look at it because, as you can see, the price has dropped sharply over the last few months, and I think potentially that could constitute a buying opportunity if we stick to the right fundamentals. So, what does the company do? Well, we know that this is a company that operates in a defensive sector. At the moment, the company, there's a lot of fear, there's a lot of uncertainty, and the food and beverage sector is the only sector in the ISM report that has displayed growing signs for 3 months in a row. It's actually one of the few sectors that is experiencing growth on a sustained basis. So that's definitely something worth noting, and is one of the reasons why I started looking at the stock. On the ISM comments, there's a qualitative statement where you can see a bit of what's happening in each one of these sectors. And over the summer, we have seen positive commentary on healthy restaurant sales and traffic, which is definitely good because aside from the condiments that you can buy at home to cook your own food, this organization also has a solutions, flavor solutions division that sells directly to food manufacturers. So what happened with the stock? Well, in late January, so yeah, it's probably around here, they reported earnings. So they reported EPS of 60 cents versus expectations of 57. So they beat. So earnings and outlook. So earnings beat, but outlook was raised, which is definitely very, very good. But what happened? Because the stock fell quite a bit, they missed the revenue expectations, not by much, by a little bit, 0.83 miss in terms of revenue. We have to remember one thing about this organization, right? They sit in a very privileged position where they can increase earnings simply by passing the cost of to the consumer. But how sustainable is that? So it shouldn't surprise us that even though they beat earnings, the market reacted in this way, because at the end of the day, it's still a very, very competitive industry. But overall, they sit in a good place where they can just raise prices, sell this, and still beat their EPS. So that's what happened. Now in October, so yeah, we're sitting around here in early October. They met their EPS expectations of 65 cents. But unfortunately, again, they miss revenue expectations. So we have a stock here in a defensive sector gone from 93 to low 70s and then back to the 60 mark, and it's currently sitting at around 65. So it's gone down quite a bit. It's down around 50%. So we should not fight this momentum, okay? Remember this, picking bottoms, dirty fingers. There's a lot of momentum pushing the stock down here. So even though I have a long predisposition, I have a long bias, a bullish bias for the stock, I do think that the fundamentals and the technicals are not quite there yet for us to enter this trade. But you're probably wondering then, well, why have you brought us this idea to talk about today in that case? Well, I do think that, first of all, there's an opportunity here in terms of price. I'm not saying, that you should buy cheap stocks. That's not what I mean at all. But what I mean is that the sector is definitely fitting what I would get long exposure in this market at the moment. Okay, and we have here a sector that is experiencing growth. It's one of the few that is experiencing growth, and we have as well a situation with their currency, which has also been a case for their downfall over here. So one of the reasons that they attributed the worse than expected performance in the last earnings was a slower recovery than expected in China. Okay, they do have currency exposure to Asia, to Europe, and we have had a year when we had a very, very strong dollar, which was a result of the changes in interest rates by the Federal Reserve. Now, whether you think that that is over or not, I'm not going to get into that kind of commentary. You can have your own idea to that. But it's not going to be happening indefinitely, that's for sure. And I think we are probably closer to the end. Not sure if we are there yet, but certainly we are getting closer to the end. So, with that, I had a look at all the parts of the world as to whether or not these fundamentals could turn for the better. And what I noticed is that the Chinese Consumer Confidence Index is increasing slowly. Now, this source comes directly from the government, so you definitely should take that with a pinch of salt. And I did. But then I noticed something quite interesting. Disney reported earnings just a few days ago. And one of the reasons why they attributed the performance, which was better than expected, was high attendance to the Shanghai and Hong Kong parks. So that signals to me that the trend in terms of the strength of the consumer in China may be starting to turn for the better. Okay, so this is a stock that I'm not going to enter for the time being. I'm putting it on the watch list. I would definitely not enter at these levels, and certainly even if it reaches 60, I would still be cautious about entering a long position. But there are a few things that I want to monitor in the fundamentals to make the decision whether I enter or not. First of all, the restaurant industry sales indicator, which has been getting better consistently over 2023, even on an inflation adjusted basis. The US Consumer Sentiment Report from the University of Michigan, retail sales, the China Consumer Sentiment, general emerging market FX, as well as the DXY index, inflation, both in the US and China, and also I would look at the commentary from not only peers in the market, in the food and industry sector in the US, but also in China. And you have stocks like Young China Holdings with that commentary reporting on that to gauge whether or not those fundamentals are turning. When they do, and I think they can turn relatively quickly, we could see the stock going back to maybe the 70 to 80 mark. So make your own judgment of that. I'll leave it with you for today, and thank you for coming.